Welcome back. You're watching Stock Picks, and today we unpack Astral, Deree Co, as well as Johnson & Johnson with Gary Booysen from Ransford. Gary, a pleasure. Good afternoon to you.
Good afternoon. Thanks for having me.
All right, Gary, before we get into the counters, let's talk about why you've chosen them. Was it an arbitrary selection, or were you purposeful in this one?
Well, it's not an arbitrary selection. It was actually, I suppose, whenever you give stock picks in the public like this, you try to give people value and trying to get good entry points as well, because every now and again these get tracked, and so I think technically these stocks are all looking pretty good, and there's all some event news around them that will serve as a catalyst. I suppose if we're trying to draw together a general theme today, other than Johnson & Johnson, I suppose Astral and John Deere, they're both kind of farming businesses, but Johnson & Johnson doesn't really fit in there as now a pharmaceutical company. But I think really from a technical basis, we have nice entry levels on a lot of them, and there's a lot of reasons to buy.
Let's talk about Astral, because Astral released a set of numbers yesterday, so all of that's still fresh in our minds. It has been a shocking period for Astral. I think, first of its kind, first loss in 23 years.
Yeah, first loss in 23 years, and you can understand why this loss has happened, and I think the market is looking through the results. So the last, as I said, there's a catalyst to why we selected it today, and you can see the share price reaction to these results. First loss in 23 years. We're talking about revenue, which came in at 19.3 billion, but down 0.4%, and a whopping 621 million rand loss. So a decline in earnings per share of 148%. So that is terrible, terrible news, and yet we've had the stock up strongly since the announcement, and I think not as bad as the market was expecting. Now, why was the market expecting such a terrible set of results from Astral? Well, of course, we have the avian influenza. There's bird flu going around. There's been culling of chickens, across specifically Gauteng and Mpumalanga, and this is obviously going to have an impact on Astral's bottom line. At the same time, we're in a high interest rate environment. The consumers are under pressure. They're having to shift their protein consumption away from more expensive chicken. So it's been very difficult for Astral to put through the price increases. At the same time, we have power issues, water issues. All of this is delaying the slaughtering of birds. So we're seeing much fatter, heavier birds that require longer feeding. And Astral hasn't been able to slaughter on schedule. And that's also created enormous problems for the company. But as I said, the stock price is up aggressively for 2 days. And that's because it does look like there's a valuation argument here, and it does look like if you look out to kind of the end of next year, you can easily see a recovery. This is a very, very cyclical business. The shares have been punished on the expectations that these results were going to be good, going to be at least very bad. The business, they've obviously cancelled their dividend as well. Never good news for shareholders, but the focus is going to be on repairing the balance sheet, getting back to being a dividend-paying company, and hopefully with a little bit of tariff protection, which is already in place, just patching up as a business. And I think, as I said, very, very cyclical. You tend to get a lot of share price volatility in something like Astral. So picking it, where it's trading at the moment, sort of mid 150s, I can easily see the stock recovering back above 200 Rand a share. And it does look like a good entry point into the sector, a sector that is absolutely critical in the South African economy. We have to eat, and Astral is fulfilling a very basic need for South Africans. So definitely something that we'd be adding to portfolios.
I think yesterday when I spoke to the CEO, he had said that they can only do what they've seen the last year or so for one period, and then things have to pick up from there. And so I'm very hopeful about the prospects of the business. I'm wondering, though, Gary, from a risk perspective, the uncontrollables for this company seem to be quite a bit. Of course, they've done quite a bit to build resilience in electricity. Also, really also doing the same with water. But things like this flu, this avian flu, just seems to be something that is cyclical and does happen in the poultry industry once every few years.
Yeah, I think it's one of the risks that you've got to adopt when buying a company like this. This is not, this is always going to be a volatile share, but you do expect things to get better over time. Avian influenza, it's part of the yeah, it's part of the operating environment for all chicken businesses. So yes, it's unfortunate that it's happened now, but and I mean there are concerns that it isn't being brought under control, and that more needs to be done. But at the same time, when you're an investor, you've got to take a longer term view. You've got to look at this as a one-off item that's creating a narrative around the stock that's helping to drive the shares lower, and really giving you an investment opportunity over the long term. So this is an entry point that we do believe that this avian influenza is going to be temporary in the grand scheme of things, and it's not the type of impact that is going to put Astral out of business. It really is the juggernaut in the sector. It's been called the OPEC of chickens in South Africa. So it really, I mean, there's a good chance, looking at the substitute products that come in from overseas, they're a lot more expensive than domestically reared birds, and just that is probably going to allow Astral to put through some price increases. That's going to quickly patch up the balance sheet, and then hopefully give investors a decent return going forward.
Very interesting one there, Gary. Let's take a look at Johnson & Johnson. When I Google Johnson & Johnson, lots of litigation. I'm not sure what's happening there. If that's the name of the game in the big pharma space, actually in the US.
Yeah, so remember, Johnson & Johnson is a very different business, ever since the unbundling of the consumer healthcare, at least the consumer health business, and now its focus is purely pharmaceutical and medical devices. So they operate in two divisions: the pharmaceutical division, which is actually being relabeled now because the business is in some transition as innovative medicine, and it operates in 6 areas: so infectious disease, neuroscience, immunology, oncology, cardiovascular, metabolism, and pulmonary hypertension, if I can say that. And then obviously that's the one business. The other business is medical tech as well. So a whole range of products that cater for surgery, orthopedics, vision, all sorts of different medical devices. It is a very different business. You obviously mentioned, I think it is to an extent par for the course that pharmaceutical businesses do have obviously very tight regulation around their products, and I mean they are obviously, every now and again, when you're operating at the scale that a Johnson & Johnson operates at, you're going to always face some sort of regulatory issues, and you're going to face some sort of court case somewhere along the lines. But overall, the business has changed its focus really to focus on pharma and medical devices because they're trying to put themselves back on a growth footing. If you look at the third quarter sales, they're now forecasting full year revenue of around between 83.6 billion and 84 billion, just to give you the scope of the revenue line of this business. If you look at their earnings guidance between $10.07 and $10.13, also a significant lift to where they were previously. Part of that is an acquisition that they did in the medical device space, that being integrated into the company. So I think a lot of interesting things happening within the business, a much more focused business. I think one of the risks around it, you've kind of already mentioned the regulatory risks, but it's also the decline in COVID sales. We've seen Pfizer's share price being impacted as well, less vaccine sales, and immediately the market kind of reacting to that and saying, oh, these businesses need to be marked down. But I think it's those markdowns that are giving you an opportunity to enter into, I think, at a very decent level. And again, if you go look at kind of the share price chart, you'll see it's pulled back to a lower support line, and a lot of that has, I think, been to do with the negativity around the COVID vaccine sales, and potentially we get an uplift from here.
What's also interesting about this one, and I'm wondering if it's just the name of the game also with pharmaceuticals, is that acquisitions are a normal here. It's very seldom that a company like this would grow organically and build a business from the inside, Gary. And I'm wondering what then it means for the balance sheet, because what we know is that, of course, that's more value coming in.
Yeah, Johnson & Johnson, after unbundling their consumer health business, their balance sheet is very, very strong. So, looking at it, they aren't kind of telegraph big deals in the pipeline at this stage. So we're not expecting any kind of headline announcements to come out that they're buying this or that. But you're 100% right. It's the nature of the pharmaceutical segment. Whether you look at something like Pfizer or AstraZeneca or Glaxo, Johnson & Johnson now clearly in the pharma space. The nature is to see these smaller biotech companies, once they create what is going to be a blockbuster drug in future, you see them being acquired by the kind of heavyweights in the sector, and Johnson & Johnson is one of those. So, looking at their existing products, the likes of Remicade, Zytiga, there is obviously biosimilar competition, and these are drugs that are quite mature in the pipeline, but that shouldn't be a concern for a company the size of Johnson & Johnson, because, as you say, it's the nature of almost like a tech business, and pharma to an extent needs to be compared to tech. When the new drugs are developed, when these interesting new smaller biotech companies develop an interesting new essentially molecule or product, that's where the Johnson & Johnson steps in and helps them generate the scale that they can. That is very unique to in terms of the manufacturing, in terms of the distribution, and obviously in terms of the funding as well.
Let's move back into the agri space, Gary, Deree Co. Let's talk about this company and how it plays in the agricultural sector. But I think it also a dominant player, I think, with tractors. I have never heard of a tractor, so learned something new today.
So it's a simplification to say it's a big tractor selling company, but they operate across also three divisions. So production and precision, which specifically focuses on large grains, small grains, cotton and sugarcane. Then that's about 46% of their business by revenue. Then small agriculture and turf is the second segment. This looks at like high value crop, livestock and dairy, and then of course construction and forestry, which you can think of like those big yellow machinery that accounts for about 26% of revenue. So, a massive range of vehicles that are supplied into the agricultural space. But I think what's interesting about this company is actually the technology that they're developing currently. So, they've identified around 150 billion rand market gap that they can fill through kind of very, very precision implementation. And I mean, watching their latest investor day and the technology products that are coming to market, if you look at the John Deere tech stack, it is absolutely incredible. You're talking about these big kind of combine harvesters or these irrigation machines that have GPSs and GPUs sitting inside them that create a data set, immediately upload that to a cloud, is analyzed at John Deere, that can then be fed back into farmers to optimize their farms. They collect data on everything from soil types to the fertilizer type being used to the way that the farmer is irrigating the specific shape of field, and then relate this all to the yield that the farmer can produce. So, a massive amount of interesting data that can be applied. And when you look at what these machines allow people to do, it really is incredible. You're talking about people that plant sort of 50 million to 500 million seeds, and their entire staff complement is 8 or 9 people, because they have the technology and the machines to be able to do this. So food security, obviously, a key theme going forward, and John Deere, squarely in that space. So labor in the US, I mean, 53% of their sales come from the US. Labor in the US is becoming a little bit more expensive. Automation is a clear focus in the agri space, and that's where it is, and it's cheap. I mean, if you look at some of the tech companies out there, and I mean, I would almost argue that Deree Co is a tech company to an extent. I mean, you've got these things trading on sort of 40 times sales. John Deere trading at 1.78 times sales, and it's trading on an 11 PE, yet it has a 5-year compound profit after tax growth rate of 26%. So this is, it's an incredibly cheap company, incredibly high quality company. It has the economies of scale. It's very, very difficult to compete with. It's slightly smaller than Caterpillar, which is its big rival. But I mean, this is a business that started selling tractors in 1918. It's got 82,000 employees. This is an absolute juggernaut in the sector, and when you have that size and the kind of information that they have, I think it's incredibly difficult to compete with them, in any meaningful way. So yeah, entrenched in the segment, got the economies of scale that you need, and not expensive. Definitely something to be adding to a portfolio.
It does sound like a capital intensive business. I'm wondering if that at all, is a barrier to its growth, or if, then you just kind of stock on that balance sheet, make it strong enough, and make sure that you've got the working capital to churn out the machinery as you should.
Yeah, absolutely. So it is also a cyclical business. So we're talking about farming today. Farming is always going to be a cyclical business, and you are right in that farmers specifically can delay their capital expenditure if you're moving into an economic downturn. So if the likes of maize prices are falling and farms are becoming less profitable, absolutely you can say, well, actually we're not going to buy new machinery this year. We'll delay that spending for a couple of years. But yeah, I think looking at the valuation around the stock, markets need to look through that. If you're buying any equity, you should have at least a 5 to 10 year view on holding it. This, John Deere for me is going to be, you buy this through the cycle. You've had a nice pullback from highs, from kind of $450 a share down to around $380 a share. You've got a nice correction to buy into at the moment. And as I said, the valuation for me is compelling.
And for our retail investors sitting at home, Gary, wondering in what order they would or could enter these counters, which order would you go in?
Yeah, it's difficult to put an order on them exactly. So today I would probably buy Deree Company. I think it's probably more compelling. Johnson & Johnson, I think you might have a little bit more time on. I still think that the actual entry point is excellent. But if I had to put an order, I'd say John Deere first, then probably Astral, and then Johnson & Johnson third. So 1 John Deere, 2 Astral, 3 Johnson & Johnson.
And
of course, that depends on if you want offshore or local. There's a lot of factors you need to consider when putting those in that order.
Absolutely, Gary. Let's talk about the price earnings to growth ratio. That's one we don't hear of often, but I think it might be one of the most comprehensive ratios we have out there.
Well, I suppose you need to understand it first. So everyone understands a price earnings ratio, and that gives you a basic valuation of the stock. How much are you paying in earnings terms? Now, all a PEG ratio does, so price to earnings growth ratio, is it kind of adds that expectation component. So it changes it quite a lot because it depends on what your expectation is, of the earnings growth, and depending on what you're using as your earnings growth estimate, that's going to change your PEG ratio. So it's not something that you can say the PEG ratio on this stock is 1.2. Or the PEG ratio is 0.8, because it really depends on what your inputs are that you're using. But where it is particularly useful, and I suppose it's, I used to sit, or I still sort of sit on a trading desk, is when you have to analyze results very, very quickly to see whether or not the earnings look reasonable or not. And typically a PEG of 1 is kind of seen as fair value, but it gives you a very quick way to look at the results and say, were those earnings enough? Was that earnings growth enough to justify the price of the stock? And all you do is you take the PE ratio and you look at the growth, and you kind of create your own PEG ratio. So if ShopRite is trading, let's say, at a P last 12 months or historical PE ratio of 20, and the earnings growth rate is 20, then you're sitting on essentially a PEG of 1. You're saying the stock, the earnings have grown by 20%. The stock is on a 20 PE. Your PEG is sitting at around 1. So it gives you a very quick way to realize if the earnings growth was high enough in a stock, if you haven't got actual underlying estimates. So if you look at a stock and the P ratio is 15 and it comes out with earnings growth of 30%, suddenly you're looking at this saying, hey, that's a PEG of half. Those were really good results. So it gives you a way to quickly react to a SENS announcement or a trading statement without having to go out and dig out detailed estimates. Of course, it also gives you a nice valuation tool if you have your own estimates on where the earnings growth is going to be, or if you're lucky enough to have a team of analysts that are putting these together for you. You can then also use it as a valuation metric to try and help you select better stocks.
Well, Gary, it's always a pleasure learning from you. Thank you so much for your time this afternoon. That was Gary Booysen from Rand Swiss.